So name of the reading is Risk Management Application for Off Option Strategies. One fundamental assumption with this reading at CFA Level 3 is that all of you are extremely comfortable with long call, short call, long put and short put. You understand how the numbers flow, in which direction you have a position. So the reading is roughly divided into three parts. So first part is more focused on the option strategies. Right, so this is relatively the newer part at CFA Level 3. So we have a repetition of covered call, we have a repetition of protective put, and then after that we have all the new strategies. So we have box spreads, we have butterflies, then we have bull spreads, bear spreads, we also have straddles and strangles. So this portion will take us roughly about 60 minutes to get through. Once we are through with the strategies, then there is some part on interest rate options. So relatively more or less repetition of what we've done at CFA level 1 and 2. So what is interest rate call option and how does it impact the value of portfolio? So we have to do some computation which are slightly different in nature but should not be very difficult for us. And the last section is focused on option Greeks. So at level 2 we did a big chunk of option Greeks. At level 3 we have focused more from a risk management perspective. So we would be focusing more on deltas and gammas and their use for hedging purpose. So let us get ourselves started with option strategies directly. Now may I assume that you people are reasonably comfortable with basics of options? Long call, short call, long put and short put. So let's start with the first strategy, which is covered call. Now for each of the strategy, we would be discussing when to use it. And see, there are extremely complicated formulas given in Schweizer's as well as in curriculum. You do not need any of them if you learn to think through the process. So what is important is you try to understand when do you use which strategy, and once you understand, then the formulas could be not necessary. You can just get the answer through simple logic. So covered call is used when you are mildly bullish or neutral on a stock. If you are mildly bullish or neutral on a stock, then the appropriate strategy to be used is the covered call strategy. Okay, so you think that the stock price might go up a little, but it would not be very significant. So let us say that right now the price of the underlying is 100. You're of the opinion that in next 3 months the value of the stock might become 105. So which means in next 3 months the holding period return that you will have would be of 5% on the underlying. So you somehow want to enhance the return. Now you do not want to exit the stock because maybe after 3 months you are expecting a very strong upside. So you want to hold on to the stock, but you want to increase your return for this period of 3 months. So what you can do is, if you think that spot price would reach only up to 105, you can take a short call position with a strike price of, let us say, 105. And let us say on this short call position, you get to earn a premium of 11. Now imagine what happens if you write about your prediction. If on the date of expiry, if the spot price actually turns out to be 105, then you will get to earn 5 on the underlying, plus you will get to earn 11 because the option would remain at the money. So your total return, you would be able to enhance up to 16% by employing this strategy. But what if you were wrong and on the date of expiry the stock price became 150, it just zoomed up. So even if it becomes 150, by taking covered call you have restricted your upside. So no matter what, you will have to sell your stock at a price of 105 and therefore your return would be restricted to 16. Are you fine? But what if on the date of expiry, your spot price comes out to be 70? If it comes out to be 70, then again you were wrong about your prediction. You will have a loss of 30, but you received premium of 11, and therefore your net loss will become 90. So the maximum loss will happen when the spot price will become 0, and in that case your loss would be minus 100 plus 11, which would be 89. Are we clear with this? So let's do one example here. Let us say spot is 175. Strike price of call option is 190. The premium on this option is 22. Question number 1, find out maximum profit, maximum loss, and find out break-even point for this strategy. Then find out profit or loss when the price of the underlying is 120 or 150 or 185 or 190 or 205 or 350. Find out profit or loss in each of these 6 scenarios. Alright, so how do we get the answer? So your spot price was 175. You are going to cap your upside at 190, and the premium that you are going to earn is 22. So number 1, maximum profit. So 175 stock sold for 190, so that's a profit of 15 plus premium of 22, so that is 37. Loss will happen when 175 becomes 0. So 175, but premium will save us to some extent, and therefore your net profit or loss would be 153. Break-even point. So this 175 should go down in such a way that it offsets the benefit of premium. So when you say 175 minus 22, which is your premium, your break-even point is 153. Are we okay here? When the stock price goes down to 120, 175 stock went down to 120, so we have a loss of 55, but premium of 22. When we have when the stock price goes to 150, we have a loss of 25, but premium of 22. When it goes to 185, we have a profit of 10, premium of 22. When it goes to 190, we have a profit of 15, premium of 22. 205, we don't get that benefit, so 15 plus 22, 15 plus 22. Are we comfortable here? Any questions you would like to ask? Should we go ahead? Next strategy is fiduciary call. Fiduciary call is billed as, tell me. A fiduciary call is purchasing a zero coupon bond and having a long call position. You purchase a zero coupon bond and you take a long call position. Now the condition is that the face value of the zero coupon bond and the strike price of long call, they have to be same. So let us imagine that we invested 91 into a zero coupon bond at the rate of 10%, assuming that in 1 year it will become 100. And we purchase a call option with a strike price of 100. Now see how does it behave? If on the date of expiry your spot price is 150, 130, 170, 190, we will have a right to buy at what price? 100, and we will have 100 because your bond will expire at 100 on the date of expiry. So you will convert this position into a stock. But on the date of expiry, if the spot price is 70, 80, 50, 40, then the option would be out of the money. Then you would just keep yourself that 100. So you would convert yourself into a bond. Right? So if there is an upside, this portfolio becomes a stock. If there is a downside, this portfolio becomes a simply face value of the bond or cash. Are we together on this? Next strategy is protective put. And of course, from put call parity, if you remember, fiduciary call and protective put are the same values. They will always result into same values. So in a protective put, you have a long stock, plus you have a long put. Now, let us keep the same scenario that the strike rate is 100. So on the date of expiry, if the spot price turns out to be 150, 170 or 200 or 120, then that put option is out of the money, you don't use it, and therefore you would always convert yourself into a stock. But on the date of expiry, if the underlying price turns out to be 70, 80, 60, then that put option will allow you to sell that stock at what price? 100, and therefore you would have 100 with yourself, which was similar to having 100 worth of cash. Are we clear with this? So what you might want to write down for the exams, that both protective put and fiduciary call, when the underlying is upwards, they convert themselves into a stock. And when the price of the underlying has fallen downwards, so let me write it this way, this is above strike price and this is below strike price. So if the price of the underlying has fallen below, then they convert themselves to cash, which is equal to face value of the bond, which is equal to the strike price. Any questions you want to ask here? Should we go ahead? Next strategy is called bull spread. So the very fact that we have the word bull here tells us it is a direction based strategy. Right? So I'm sure all of you would appreciate that either we have the directional trades or there are non-directional trades. In directional trades, you have a view of the market. You expect either the prices will go up or the prices will go down. In a non-directional trade, you do not have a view. So here in NDTs, you take a view on volatility. So you expect either the volatility will go up or the volatility will go down irrespective of the direction. So bull spread is a directional trade and the direction is upside. Sorry for this. Direction is upside. We are expecting stock prices to go up. Now there are two ways in which we can build a bull spread. We can build them either using the call options or we can build them using the put options. So if you are building a bull spread with the call, then leave some space below this and then say we should have a net premium outflow. But if you are going to build a bull spread with the help of put, then we should have a net premium inflow. So let us say we have two call options, one with the strike price of 100 and other with the strike price of 200. Now, which one of these two options you think would be more expensive? Which one of these two would be more expensive? 100. So since we want to have a net premium outflow, the way you think of this, that we will buy the one which is more expensive, we will sell the one which is less expensive, and this would create a bull spread for us. Okay, so this flowchart we are building just to help you memorize what position to take in which type of option to build the spread. Now let us say we have two put options. Now which one of these would be expensive? 200. So since we want to have a net premium inflow here, we will sell the one which is expensive and we will buy the one which is cheaper. That means we will take a short position on 200, we will take a long position on 100. We will sell put option with a strike price of 200 so that we will receive more premium, and we will buy put option with a strike price of 100 so that we will have to pay lesser premium. So we will have a net premium inflow. Are you fine with this? So let us do an example of them so that you get comfortable. Should I clear off the screen? So let us say that premium of call option strike price 200 is 35 and premium of the call option here is 115. So these are the premiums. So we are going to take long position on which one? 100. And we are going to take short position on which one? 35. So how you always think on a bull spread, you find out what is your net investment. Find out what is your net investment. Here your net investment would be how much? Net investment is 80. Because we are going to receive 35, we are going to pay 115. Now imagine, since it's a bull spread, imagine your view on the market was correct. Your view on the market was correct and the spot price turned out to be 500. Spot price turned out to be 500. So then we will buy the stock at what price? So let me write it explicitly. Buy stock at 100. And we will sell stock at what price? Sell stock at 200. So you bought the stock at 100, you sold the stock at 200. How much is your profit here? Your profit is 100. But what was your investment? Your investment was 80 and therefore we have that spread available to us on the bull side, which is your net profit, and your net profit in this case is going to be 20. Your premium is gone. Your premium 115 is gone if the markets are falling down. And then what if market goes up again? Now imagine this is not 500. Let us say this is 700. Then what happens? Same. If this is 300, same. This is 250, same. So this is a maximum profit that we are going to earn on this particular strategy. Are you following this? But what if this price comes out to be 180? If the price comes out to be 180, then we will buy the stock at how much? So I'm writing here. Then we will buy stock at a price of 100. Will we get to sell the stock at 200? No, because we have a short call position. But we can sell the stock at the current market price of 180. So we have a profit here of how much? We have a profit of 80. But what was your net investment? Net investment 80, and therefore we will hit the break-even point. So break-even point in this scenario would be of 180. The thought process is that the lower call option should generate you profit, lower strike price call option should generate you profit which is equal to the net investment. Right, so once that 100 gets you 80, that 80 gets set off and then you hit your break-even point. Are we fine with this? Now what if the price of the underlying turns out to be 150? Then we have a profit of 50, but we have an investment of 80. Therefore, we will have net loss of 30. What if the price of the underlying turns out to be less than 100? Let's say it turns out to be 70. Then both the options are out of the money, and then we will have a loss of 80. Which means with a bull spread, the maximum loss that we will have is the amount of original investment, which is 80. Are you finding this difficult? Okay, so let's do one more then. So let us say we have two call options. Strike price of the first call is 65. Strike price of the second call is 55. Premium here is 3.5 and premium here is 1.5. You have to find out maximum profit, maximum loss, break-even point, then profit when the price of the underlying is 40, profit when the price of the underlying is 60, profit when the price of the underlying is 58.5, when it is 70, when it is 75, and when it is 100. So for those of you who are finding this difficult, if you get a scenario like this on the exam, what you can write is something like this. You can say we have to, so write it this way, we can buy at 55 and we have to sell at 65. Okay. Now, what is the net investment we have done? Your net investment, we bought the expensive call option, we sold the cheaper one, so your net investment is of 2. Now, if price of the underlying goes above 65, then we will buy at 55, we will sell at 65, your investment of 2, so your maximum profit is 8. Should I repeat this? You bought at 55, you sold at 65, minus 2, your profit is 8. If the price goes below 55, then we would lose the entire investment, so your maximum loss is 2. For break-even point to reach above 55, we should be able to recover your investment of 2. Therefore, your break-even point should be 57. If we are below 55, then we have a loss of 2. Here we are recovering 5, but we have invested 2, so we have a profit of 3. Here 58.5, we have a profit of 3.5, investment of 2, so net profit 1.5. At 70, we have the maximum profit of 8, maximum profit of 8, maximum profit of 8.